Here's a stock investing strategy that returned over 18% for the last 35 years. Let's see how to beat the market with free cash flow. Now, we're in very volatile times, but the reality is the longer you look into the past, the more mispriced opportunities you find when the stock market herd is irrational. Now, that doesn't mean stocks will always go up, but it does mean you can always find undervalued opportunities. So Richard Branson said, never take your eyes off the cash flow because it's the lifeblood of the business. So today we're going to learn about free cash flow and why it's so important for valuing a business. We can start off with the cash flow statement, one of the financial statements. So this is broken down into three pieces: the operating cash flow, the investing cash flow, and the financing cash flow. Operating cash flow comes from normal business operations, and the free cash flow is defined as the operating cash flow minus the capital expenditures, the CapEx, money that goes back into investing in the business to give us this equation. Now, free cash flow has some advantages. Because we're dealing with cash flow, we avoid non-cash expenses, depreciation, amortization, and we're considering the CapEx contribution. Now, free cash flow is a very important quantity when it comes to valuation and a discounted cash flow model, which we can talk about in a future video. But for our purposes, we want to use it as a valuation metric. And so when we have the free cash flow of a company, we can turn that into a free cash flow yield, which is the free cash flow divided by the market cap. And the way you can think of this is that we can put money into a business to acquire a share, let's say at $100, and in return, we get a certain amount of free cash flow. And so if the free cash flow yield is 10%, that means we're getting 10% back in terms of free cash flow for the $100 we put in to acquire that slice of equity ownership in the business. Now, yields are nice because they can be compared to other yields, other percentages, such as the risk-free rate, for example, the 10-year treasury rate. And so it allows us to compare apples and apples when we're looking at the valuation of a stock. So let's go ahead and look at a specific example of free cash flow yield. So here we are at ValueGlance.com, using it to analyze whatever stock we're interested in. So if we come over here to the stocks tab, we can look at, for example, Walmart. So here's Walmart. We can go to the bottom here and look at different metrics. For our purposes, we want to select free cash flow yield. Let's clear out some of these other ones, and we can add in the price. Now let's go up here to the chart. We could drag this to zoom out. Let's take a look over the last 35 years here, really looking at the long-term trends for Walmart. And what we're plotting are two lines here. So in green, we have the free cash flow yield, shown as a percentage. You can see here negative 5% in April 93. And then we have a black line here for the price. And so what we'll notice is that when the free cash flow yield goes up, meaning you're getting more free cash in exchange for the share that you're buying, a few years after that, we see, no surprise, price starts to take off. And when free cash flow yield drops down, meaning you're not getting a lot of free cash flow in exchange for the price of a share that you're buying, we see the price flattened out. So this is a nice example that illustrates free cash flow yield in terms of a valuation for stocks. It's a very simplified metric, but nonetheless, it is a very powerful metric. We see again here 2009, 2008, if the share price crashes and free cash flow stays constant, because free cash flow is in the numerator and let's say market cap in the denominator, that sends the yields up. And so that means it's a good time to buy, again, because you're getting free cash flow in exchange for that share. And we see here, after trading flat for a decade, starts to pick up a little bit. Free cash flow yield comes down. We see free cash flow yield spiking in 2017. And as it worked its way down, share price took off again. So this is looking at the correlation here. But if we really want to test this over the long term, we have to put the strategy to the test and construct an actual portfolio. So let's go over to the backtester feature over here. So this backtester feature allows us to test a strategy over the long term, over the last 30, 35 years. So what we can do is click create new backtest. We can come over here, look at a customized screener. So let's look at this example here. Market cap above 0.1 billion, so 100 million plus market cap. And our key metric here, free cash flow yield above 20%. In other words, you buy a share for $100 and you get $20 in exchange of free cash flow. So that's our free cash flow yield, our valuation metric, telling us that the company is generating free cash flow, a lot of free cash flow relative to a share price. And then we can go ahead and construct a portfolio. And so when we come to step 2 here, we can set up our back tester. I like to go as long as possible. So Q4 here, going back to 1990, we can name it free cash flow yield 20. We can go ahead and run this. And so this will construct a portfolio every quarter for the last 35 years of stocks that satisfy this metric. If there's a lot of stocks, we'll take 30 random stocks, construct our own portfolio, and see how it performs. So we click Run Backtest. So I've already ran an example of this, and we can see the results here. And so we see this is the real backtest result. We see in blue the S&P 500 line. So this is the market. And on the vertical axis, we're showing the growth of $1. So you put in $1 1990, and we see how it grows over 35 years. And here in brown, we have our strategy. So this cash machine strategy, generating high free cash flow yield. Now, you can barely see the S&P 500 line here because we're on a linear scale. So if we press this log button, now it's much more clear. We look on the vertical axis, we see this is on the log scale in powers of 10. So we start off with $1, and we see how that portfolio grows with time. If we click on any individual quarter, we can see on this pie chart to the right, we have a lot of companies here, 16 companies, 23 companies. And so you could see over the years, this is quite a diversified portfolio. We're not talking about 1 or 2 companies here, 20, 30 companies. So nicely diversified over the years. And we see the S&P 500 in blue, that turns $1 into about $17, so shown up here. So that's an 8.5% annualized return over this entire period. How did our strategy do? We see $1 was turned into $428. So over $400, that's an annualized return over 18%, nearly 19%, using one metric, free cash flow yield, and looking at this range of market caps above 100 million market cap. So that's a powerful metric here. Just one number, free cash flow yield, that tells us not only about the company's ability to generate cash, but generate a large amount of cash and free cash flow relative to the share that you're paying. And so using that metric, we see over 35 years through tech bubbles, housing bubbles, pandemics, wars, booms, busts cycles, the ups and downs of the market cycle, this still wins over the long term. So that's a great reason to go with the free cash flow. So we've seen how this one metric, free cash flow yield, beats the market over the long term, nearly double the annualized compound rate of the S&P 500 through the booms and busts. It shows why companies generating tons of cash relative to their share price can win over the long run. So if you want to test out your own strategy, check out ValueGlance.com. You can get my book, Stop Checking the Price. It's available on Amazon, where we learn how to find high-quality companies that win over the long run. And you can sign up for our free newsletter, the ValueGlance Substack, where you'll get a code to use the ValueGlance tool, 1 month free. So please check that out, and good luck finding these cash flow money printing machines.